The ADAS model is a tool used in macroeconomic analysis. This model shows the general equilibrium situation in the economy at the intersection of aggregate demand and aggregate supply curves. The aggregate demand curve reflects the relationship between the inflation rate and the level of aggregate output when the goods and services market and the financial market are in equilibrium. The aggregate supply curve reflects the relationship between the price level and the aggregate output level when the labor market is in equilibrium. In the ADAS model, balance emerges in different ways in the short and long term. In the short run, prices and wages are sticky, meaning they cannot adapt quickly to market conditions. Therefore, the aggregate supply curve is positively sloping in the short run.
This curve is affected by factors such as expected inflation, price shocks, and a persistent output gap. In the short run, equilibrium occurs at the intersection of aggregate demand and aggregate supply curves. At this point, the total output level may differ from the potential output level. In the long run, prices and wages are flexible, meaning they can adapt to market conditions. Therefore, the aggregate supply curve is vertical in the long run. This curve is influenced by factors that determine the potential level of output. These include the amount of capital and labor, the availability of technology and natural resources. Potential output is defined as the level of output or potential gross domestic product that the economy can produce at a constant rate of inflation. Statistical and econometric methods are used using available data to estimate potential output.
The following factors are necessary for potential output to increase. Increased supply of labor, for example due to high birth rate, increased availability of natural resources, increase in capital accumulation or stock, increasing market efficiency, increased liquidity. Being supportive of government policies. In this article, we have explained the shape of the aggregate supply curve in the long run and the factors that play a role in determining potential output. The importance of potential output is that it is used to calculate the output gap when assessing the economy's performance. The output gap is the difference between actual and potential output. If actual output is below potential output, the economy is in distress. The output gap is negative, putting downward pressure on inflation. If actual output is above potential output, the economy is overheating. The output gap is positive, putting upward pressure on inflation.